batting or until they feel that the market potential or their objective has run out. So if large capitalized traders, if they're not confident enough to add to positions or if they're getting out of positions, I think that's what happens to the market. It stops moving higher in price. And so therefore, in an uptrend, that's how a doji forms. They start buying on the open and they see that there may be something there that gives them a little hesitation, and they decide to get out of their positions, and the market will fall right back down to where the market opens. And the opposite is true in downtrends. My favorite phrase is this, and we've all heard this from Sir Isaac Newton: a body in motion tends to stay in motion until a force or obstacle stops or changes that motion. It's the law of relativity. The doji represents that force. It generally stops or changes the motion or momentum of a market. And my belief is that that's when you see a doji, things are occurring. There's a change taking place. Think about it. If you're in an uptrend, you see higher close and open, higher close and open, a lot of green candles, and all of a sudden you see a neutral candle where the market closes where it opened. Isn't that a change? The market condition is changing. It's changed from going up and green candles to all of a sudden a black candle, because there is no body or definition when the market closes at its open. And therefore, we see that neutrality or neutral, and that indicates there's a change. And that's what the doji does. It represents that change in motion or loss in momentum. So here we have one of my signature setups. I call it the failed doji top signal. If the market, and this is very critical, if the market is between pivot point resistance spots, especially on weekly and monthly numbers, if we see a doji top, and if the market closes above the doji high within the next 1 to 2 candles, we want to look at going long the market on that close, and we want to risk a stop close below the doji low. So this is actually a rule, and it's written in your course manual. Let's go through and define exactly what this means. Now, like I just went through, several educators talk about sell every time you see a doji high, and that just generally is not the appropriate advice. I think you can't be rigid. You need to be flexible in your trading approach in the market. Notice here we have a doji top in the market. Actually, I didn't draw that effectively because the market closed above that doji high here. But notice here as well, the market, we see a doji top, and what happens? We see the market close once, twice, 3 times above the doji high. So you need to buy on the close and risk a stop close below that doji low right there. And that's the failed doji top pattern. At the very least, if you decide that between the level of entry and the level of risk is too much for your account, then what you need to do is just at least recognize that you shouldn't be selling short and maybe look for other buying opportunities. This is a benchmark breakout candle. Notice that we'll go through this, but I thought I'd also demonstrate how powerful and how often and frequent these candles form, while just to take the opportunity to show you now. On a benchmark candle, the midpoint should act as support all the way down to the open. So instead of buying the breakout and getting scared out down here, look for the pullback to the midpoint, and you place a stop below the open of the benchmark candle on what's called a stop close only order. A stop close only order. The failed doji top, we're looking for a higher close than the doji's high. We are now, as you see here, and again, we're looking to place a stop close only below the doji's low. We should see immediate results. Here we have immediate results. What happens though? The market forms another doji. A little scary, agreed. However, we see positive assigned value. We see an inside day, and then the market blasts off. So this is a very nice continuation pattern, and so the failed doji top is a very powerful indication. Now back here, remember I showed you that the market, here's the high. Subtle changes do occur. The market does close above the doji high, as you see right here. So watching and following dojis is a very important element. Here again, another failed doji top signal. Where the market in an uptrend, as you see, this is an uptrend. In an uptrend, all of a sudden you would imagine, or you would think that with a doji, imagine that the market is going to top out. But again, as you see with these green lines, that represents the actual range of the doji. Notice that